Right. Ron, it is an absolute pleasure to have you with us here today to open our Solarisbank Partner Summit. So thank you very much for joining us from the East Coast.
Thanks for having me.
Yeah, we're super thrilled. It's quite a privilege, actually. So to kick it straight off, in your recent Forbes article, you wrote that financial institutions have been obsessed with the customer experience for the last 20 years. But that this focus is now wrong. Considering that the unconditional focus is on the customer, namely customer centricity, and that is glorified in almost every industry, are banks wasting their time and resources? What do you think?
Well, I think wasted is too strong a word, and I don't mean to imply that the customer experience isn't important. And although I have to say, I hate the term the customer experience, because customers have lots of different experiences. And so I've never been a big fan of the term, but I don't want to downplay the importance of it. My argument is that the relative weight of prioritization and importance has shifted. And I think, past 20 years have been such a focus on the customer experience. And I think for the past 15, 20 years, financial institutions have kind of convinced themselves, and to a certain extent have been told, that their products are commodities and that the way they have to differentiate is through the customer experience. But I think we're seeing a very different trend in the market. If you look at the emerging neobank challenger banks, who aren't really banks, and so I like to call them community fintechs, they have really been focused on differentiating by the product, not the customer experience. They claim to have superior mobile banking experiences, but really where they're winning market share and winning new customers is because they've come to market with products and services that are customized, personalized for those particular segments. I think the other trend that plays in towards this is and this will get us into the embedded finance discussion as well, with so many fintechs and non-financial brands getting into financial services and offering them. And of course, in many jurisdictions, you need to have a banking license in which to do this. And so it's a partnership between the brand, whether that's a fintech or a non-financial firm, and a bank. What's the bank providing in those instances? It's not their superior customer experience, it's their products. And so that's why I'm advocating for this shift in priorities. And Layla, if you look at a bank and really simplify it between the top line and the bottom line, and there's no question, I would never argue that a great customer experience doesn't help a bank deliver its products and services more efficiently and effectively. But if you look at the top line side of the coin, what really drives revenue and growth? It's to oversimplify things, it's three things. It's the quality of the customer experience, it's the quality of the product, and it's the quality of your marketing. By that, I mean your messaging, your offers, your timing, the channels, and things like that. And so my argument is that in that triumvirate, in that three-legged triangle, banks have not been spending enough time, effort, money to build up the product quality as much as they have trying to improve their marketing and customer experience quality. And that's why my argument these days is there has to be more of a focus on the quality of the product itself.
Could not agree more, and that's why Solarisbank is doing what we're doing, because we ironically are actually the commodities empowering that in the background, and it's our partners that are really doing the value proposition piece. So shifting away from that customer experience, but really making sure that they're taking care of exactly what that customer needs.
Right, but Layla, think about that from the perspective of the brand, who's offering financial products. Why are they able to be successful at providing financial services? Is because they're integrating those financial services into their customer experience. And so to a large extent, the banks don't have control, or not that they're losing control, but in the instances that they have to generate new business, new accounts, it's through partners who actually control the customer experience, and that their ability to help their partners win more business is not by improving the customer experience, it's by providing a better product. And that's, again, I think this all kind of leads into this embedded finance discussion.
Absolutely. Ron, let's discuss whether every bank should become a banking as a service platform. What are the alternatives? What do you think?
Well, it's a tough question to answer because there are many banks who don't have to get into embedded finance in order to continue to grow, depending on their focus. I apologize to many of the attendees here because I'm probably too U.S. and American centric to a fault because that's the market I study. But here in the U.S., as I'm sure it is in other countries, we have a strong credit union movement who have grown up with a special employer group focus or other, segmented focus. Many of them have actually moved to a community charter in the past 20 years. And I think many of them are actually questioning that again. But I think, as for example, of a credit union that I worked with recently, the Los Angeles Police Federal Credit Union. Their focus isn't just police, but law enforcement professionals. And they know law enforcement professionals and their financial needs, and really their non-financial needs, better than pretty much anyone else. Do they need to get into embedded finance or become a bank as a service provider in order to continue its growth? I could make an argument that they don't, because their growth and their potential growth opportunities to expand their focus with law enforcement professionals provides them a strong level of growth opportunities over the next 20, 30 years. For other banks, however, or credit unions even, who don't have that kind of focus, don't have that kind of market and that market potential growth, they may need to look to a banking as a service strategy in order to find growth potential. So it's not everybody should do it or only a few should do it. It really becomes down to an individual institution decision and strategy, because as you well know, you can't just say, well, we're in it and let's go hang out the shingle and be a banking as a service provider. It requires building a lot of technology capabilities. It's going to really require a lot of payment modernization from an infrastructure perspective. And again, it goes back to why would you need to do that? Because you need to offer a superior product.
Mm-hmm. Mm-hmm. Couldn't agree more. It's almost impossible to talk about the future of the financial industry today without using the term embedded finance. You were one of the first to highlight the huge potential of non-banks offering their own financial services. Where do you think we are in this hype cycle?
Well, I hate to give a baseball analogy because I'm probably talking to a bunch of people who aren't super big baseball fans, but it is probably the best analogy, which is we're in the first inning. And I'm not even the second inning. We're very early in this development. In the U.S., at least, there's probably about 25 or 30 banks who've really identified the opportunity to capitalize on the embedded finance or banking as a service. If you think about it, these are sort of the flip side of the coin. Banking as a service is what banks provide in the market to companies embedding on an embedded finance strategy. So there's about 25, 30 banks, but the opportunity and the demand, Layla, my colleagues and I just fielded a survey, of US consumers to understand their interest in getting financial services from non-financial providers. And we focus mostly on gig workers, focus people who are using various gig platforms like Etsy and so forth, or creator platforms like YouTube and Instagram and TikTok, as well as other small business owners, to understand, as well as general consumers, to understand their interest in getting financial products from the platforms that they tend to do a lot of business with, especially like Uber drivers or Lyft drivers who are on that platform, for multiple hours in a day. And there's absolutely huge interest and activity already going on in terms of the obtaining financial products from these providers. But the challenge is that many of them are going into this, many of the brands or the fintechs are starting with a single product, generally a payment product, a checking account or debit card. And again, for them to grow, I believe that they have to do it by not only expanding the the other financial products that they offer, but through non-financial products as well. But I think they'll start by providing other types of financial products, especially credit and lending products. Now, if you're the brand and you've aligned yourself with a bank who has a strong product offering from a debit perspective, that bank may not have a strong credit or lending product focus. And so you need to get multiple partners to deliver on your product strategy, which is creating an opportunity for these platform infrastructure providers or embedded finance infrastructure players, companies like Move and Synctera, Item, Treasury Prime. There's a growing list of them. And I think they're still building out many of their integration capabilities. And so we're very early in this. I think it's a lot more brands, not just fintechs, but non-financial brands will begin to see more of an opportunity, not just to provide a co-branded credit card, which they've done for a long time, or maybe a buy now, pay later, or some sort of lending facility, which has been very much third party, where if you buy something and you need to finance it, it goes off to a third party. This is about integrating that into the user experience, into the purchasing process, into the decisioning process. And so, this is all getting built out today. We're really, really early in this. I also just recently conducted a survey of US banks themselves and credit unions. And there's, again, huge interest. No, I shouldn't say huge. There's still a growing interest. It's still a minority of banks who recognize this as an opportunity. But it signals to me that if there's about 25 to 30 banks in the US today that are doing this, there's easily 50 to 100 who are on the verge of launching some sort of embedded finance or banking as a service strategy in the next year or two. And what will be different for them versus the pioneers in this space is that there will be firms like Move and Synctera and Treasury Prime and Item and so forth for them to partner with in order to accelerate the development of those capabilities.
Yeah, and similarly, we found that in Europe. We conducted our research report with the Handelsblatt Institute, and they also resoundingly found 61% of consumers would be willing to utilize financial services from non-financial service providers, so the big brands. So it's across both sides of the pond, as it were, on both European shores and in the US. So that's something that we also believe it's an incredibly nascent market. We're very much at the beginning of the journey. So we feel similarly too. Who will be the biggest winner and who will be the biggest loser of the embedded finance trend? A loaded question.
Yeah, no, not a loaded question. It's a really good question. And I have to tell you that I got my analyst training back at Forrester Research years ago. And one of the mantras of Forrester was make the call. Don't be on the fence. Don't wiggle woggle around questions and things like that. And so I've taken that pretty seriously over the years. But I have to tell you, I'm going to punt on the winner or the loser because number one, we're still way too early in the game to call a winner or a loser. And I also don't think, Layla, that there is a single winner or loser. I think there are winners and not losers, but laggards. The winners will be the financial institutions who develop the ecosystems and really understand that this is not, let's go back. A lot of people in the industry, from the banking side of the coin, see embedded finance as a threat. They think, oh, these non-financial brands and fintechs are going to be, providing financial services, and they take regulatory steps, or they use the regulatory system to try to prevent it. Oh, these banks, these fintechs and non-financial brands, they're not licensed. They shouldn't be doing it. But they're not doing it without a license. They're partnering to do it. And I can just imagine the vast banks, the hatch banks, the US at least, the Solarisbanks in Europe, who just sit there and laugh and say, well, you can put your head in the sand and ignore this opportunity if you want. In simplicity, to really just kind of boil this down, This is nothing more than a new distribution channel for the bank. It's a way to sell their products and services through somebody else who can provide them the mechanism to reach their customers. And if you think about this from that angle, what have we done for years in the banking industry? We've gone to big providers from an advertising perspective. The banks have advertised in mass media channels. Why? Because it was a way to reach customers. And then more recently, banks developed capabilities around search engine optimization. Why? Because customers began their customer journey on search engines like Google and Yahoo. And so you built search engine optimizations. What's happening is that non-financial brands and fintechs are simply becoming the new distribution channel for financial services. And a bank has to learn how to sell through these channels. And so the banks that win are those that take advantage of those distribution channels, and the banks that lose are the ones that stick their heads in the sand. The other winners, though, are these technology intermediaries, the infrastructure and integration players who enable the ecosystem to be built out. Now, if you look historically at infrastructure players, there aren't a lot. We look at this going back 60, 70 years now, maybe not 70, and maybe not even 60, but at least 40, 45 years, when we had the PC revolution. At the beginning, there was competition for operating systems. I bet people under the age of 40, 45 don't remember that there were alternatives to MS-DOS back in the day, but there were. But infrastructure tends to settle around just a few providers, or more of an oligopoly than anything else. And so while today we see a lot of emerging infrastructure / integration players, my guess and bet is that some of them will get to be really big and others won't succeed to that scale. I don't necessarily think it's the banks that lose in doing this, because there will always be a market for consumers who want to go directly to the banks for whatever reasons and purposes, and to these community fintechs as well. But I do think that some of the winners that we see in this are going to be some of these infrastructure integration players who are going to just end up doing better. And I'm not anywhere close to ready to call who the winner or loser of that will be.
Yes, absolutely. And I think the point is that this is still a rapidly evolving market. But the fact is you've got to put some sort of stake in the sand and move with it, rather than putting your head in the sand, the ostrich analogy that you use there, and instead try and evolve with the landscape as it's shifting. And I sincerely hope that certainly all of the partners who are around the table with us today, and indeed our Solarians, very much know and understand that we're at the forefront of this, being one of those infrastructure providers that you speak so highly of. So with that, Ron, I would like to thank you sincerely for making time for us with the time difference and speaking to us. It's a real highlight. I'm quite starstruck. And we would love to welcome you back again in the future for your insights. It's been super interesting. Thank you very much.
Thanks, Layla. Thanks a lot for having me. Enjoy the rest of the conference.
Thank you.